Welcome to the Build Wealth Canada podcast, where it's all about becoming debt-free, accelerating your wealth, and taking control of your money. Now, here's your host, Cornell Schreiber.
Hey, it's Cornell and welcome to the Build Wealth Canada podcast. In this episode, I interview Dr. Steph Zhou from the University of Toronto. And what I found particularly interesting about Dr. Steph is that she actually created the financial literacy curriculum at the University of Toronto. And this is something that now all student doctors need to take in order to actually become full-fledged doctors. And so when designing a curriculum like this, there's obviously not enough time to cover every single topic of personal finance and investing that exists. So I wanted to pick her brain on what in her research she identified as the most important components of personal finance that we should all focus on learning and mastering, as they have the greatest impact to our financial well-being. And so in this episode, we go into detail on what these critical components actually are. Why is budgeting, or at the very least expense tracking, such a critical component, regardless of whether you're a lower income earner or a highly paid professional like a doctor, engineer, etc. We go into detail on how Dr. Steph manages this in her own life as a busy doctor and a mother, and what she teaches her students. We also cover some practical frameworks to tackle the question of, should I pay off my debt first, or invest, or do some combination of the two? And how to best view your emergency fund, especially if you're like me and struggle with the opportunity cost of leaving a large pool of money set aside when you could instead be investing it in the markets and likely earning a much higher return. Now, a little bit more about Dr. Steph. She's also the founder of the annual Physicians Financial Wellness Conference, a national philanthropic conference for physicians on financial education and practice management. She also received Canada's Top 100 Most Powerful Women Award and the Ascend Canada Social Impact Award for her work in improving economic mobility through financial literacy. And she has a popular financial education blog on Instagram and YouTube called Breaking Bad Debt. I'm thrilled to have her on, and now let's get into the podcast. All right, Dr. Steph, welcome to the show.
Yeah, thank you for having me, Cornell. It's great to see you and be part of the show.
Awesome. Thank you. So one of the areas that you focus on is the intersection between finances and health. What do you think are the highest leverage areas within these subjects that we should focus on for the greatest impact to our finances, our health, or both?
Yeah, so one of the big things that I talk about as both a physician and an educator in the financial space is how to use your finances as a tool to optimize your health. So what does this mean? The first thing is understanding your financial vitals. So for example, as a physician, we have patients with diabetes, and these patients will track their blood sugar daily, and they'll write it down on an Excel sheet that they'll bring to the clinic. And then you have other people who have hypertension, and they check their blood pressure every day, and they bring that info to the family doctor. But we have other patients who just doesn't check anything. They don't really take their medications. They don't even know what medications they are on. And as a doctor, it is much harder to properly treat this type of patient compared to the former type of patient. So when we're talking about financial vitals and knowing your financial vitals, it might include knowing things like your cash flow, your expenses, your return on your investments, whether you have an emergency fund and how big is it, how much debt or how much interest you have on your debt, and how much insurance coverage you have. These are all important things to know about when you're meeting with your financial team, who similarly to your healthcare team need to know some of these kinds of information, vital information, to give you an optimized recommendation. So, having these healthy finances also means being able to accommodate and plan for health emergencies. A lot of young people that I teach don't usually think about ending up in the hospital as a patient. But I tell all these young doctors, eventually every doctor will become a patient at some point in their careers. And this applies to the general public as well. So things like getting insurance coverage, understanding what it involves, like health, dental, disability insurance, is pretty important because you never know when you are going to be faced with a health scare or some sort of emergency Or you never know when you get diagnosed with something and it requires an expensive medication, because seeing a doctor in Canada is free, but medications are not free. And so this is where having that emergency fund, having that insurance is important to sustain your run rate should you ever have some sort of acute health emergency that takes you away from your biggest source of income, which is work. And so the importance of knowing all of this and planning around your financial situation is it gives you the foundation to buy back your time. And this is time that you can directly invest in your health through exercise, spending time with family, or preparing healthy meals and developing a healthy lifestyle, which takes time to invest in. The other thing I also find it's important is also volunteering for meaningful causes, or even knowing what money you have left over after all of your expenses are paid, after all of your investments are made, how much you have left over to donate. Also has a lot of evidence in the literature for showing that these kind of activities can have a direct impact on your health by lowering cholesterol, lowering your blood pressure, and cortisol, which is a stress hormone, lowering those levels as well.
That's wonderful. Yeah, one of the things that really fascinated me about you is that you teach future doctors about personal finance, which is very interesting. And what I found fascinating when you and I spoke offline earlier was how this is actually a mandatory component now, that doctors must basically get this financial literacy education as part of their, before they actually become full-fledged doctors. So that's really, really neat. Now, you mentioned several kind of key components here. You mentioned knowing your cash flow expenses, return on your investments, the emergency fund, how much debt you have, the interest, how much insurance coverage you have. Although it sounds like those are kind of would it be fair to say those are sort of in your mind, the key pillars that we really need to manage and be careful of? And is this kind of when you teach the curriculum and when you design it, are these the pillars that you try to teach, or is there anything else you would add to that?
Yeah, so a lot of those things are all part of good financial planning and budgeting. So I guess the one thing I didn't cover in there is like debt repayment and how frequently to have a strategy to pay down your debt, and also the importance of how to budget your income. Because for a lot of these medical students, when they are part of and they're attending the financial literacy curriculum, they don't have physician incomes. A lot of times they're coming to it with high debts. So they might not really have a lot of income coming in general. So it's so important about how they can structure their spending, how they can maximize their scholarship applications, their grant and loan applications, and how can they use their line of credit in a way that it doesn't balloon because they get like a $400,000 line of credit. So it's a lot of access to money. And if you don't have the understanding of how to budget it over your long training period that you have to have before you actually become a full attending physician, this is a big concept for a lot of the students as well.
Wonderful. Thank you. Yeah, I mean, a lot of the listeners here, they like to educate themselves and research things themselves. So I find that, obviously, I don't expect you to teach us the whole curriculum on a 1-hour podcast, but yeah. I love you mentioning these pillars, because then we as listeners can go back and say, okay, Dr. Steph, I mean, clearly you put so much thought into this, out of all the personal finance subjects, what should we actually be focusing on? Because there's only so much time you have to teach them. And so kind of identifying these pillars, now we as non-doctors can go in as well and take a look at these and say, okay, do I actually have these elements covered? Maybe I should look into this one a bit more or this one a bit more because I've maybe neglected it or didn't think about it in the past. So yeah, very, very practical advice. So thank you for sharing that. It's always nice to know, like, what have you identified as those key components? Because it's like, the subject of personal finance is so massive. There's so many things you could choose to tackle, but what are the ones that really move the needle? So thank you. I appreciate that. One of the recurring themes that I've noticed when looking over your past work and lectures is the importance, like you already mentioned, of budgeting, or at the very least, expense tracking. Now, I suspect that this may seem, I think, counterintuitive to some, since you train future doctors who end up becoming these very high-earning professionals in a lot of cases. So can you start by maybe explaining, you kind of already did a little bit, why you feel this is such a critical component of personal finance, even for higher earning individuals and families? Why can't we just say, look, I earn enough, I don't need to deal with this budgeting piece because we make a healthy income. So why worry myself with this kind of detail?
Exactly. So like, why is budgeting so important? So first thing I just have to make sure people understand is that a lot of people immediately looks at a physician or even maybe a resident physician or a med student, and they immediately think they are high earning professionals already. But the reality is that a lot of these physicians in their 20s and in their 30s, maybe even for 15 years of the time they are in school, they are actually not considered high earning because the average medical resident salary is between $60,000 to $80,000, which is actually pretty consistent with the average salary in Canada as a whole. And not to mention, they also have higher expenses than the average population because of the average debt a med student might graduate with, which is about $150,000 of debt that they accrue when they graduate, in addition to having, expensive licensing fees, examination fees, and having to pay for malpractice insurance as well. So knowing all that and knowing the types of debt that might come, this is why expense tracking is so important. Because I often tell a student or even a resident physician where you're not earning a lot is that, a lot of people think about how can I make more money? But for a student, you're so busy studying, even for a resident, you're so busy working in the hospitals doing call that you just don't have the time to really look at how to make more money through investing or how to make more money by doing more work, for instance, right? So what you do have control over is how to control how much money is leaving, how much you're spending. And so I always encourage people very early on, even if they're going to have higher income down the line, is that if you can focus on developing the spending discipline when your income is lower, this is actually just developing a good foundation for having self-control when your income increases. And it's very tempting to increase the spending significantly when you have a higher income, because after 15 years of lower income and trying to keep up with friends that you knew from maybe undergrad who wasn't in school for so long, now they're buying homes or whatever, right? It's tempting to try and suddenly keep up with them. But the harm of that is that if you suddenly increase your spending, it's like a wheel that you can't get off of, right? It's very tempting to keep spending and spending. Whereas if you had that discipline to begin with and to control your spending, but also this discipline when it comes to investing and not chasing gains, that is the key strategy to having good self-control when it comes to your finances in the future. So often we say when residents graduate and become full attending physicians is, we say live like a resident after you graduate so you don't have to live like a resident for the rest of your life, right? So if you were fairly conservative with your spending, you had good self-control as a resident, and you can continue that for a few more years to build up that strong foundation with your higher salary to pay down the debt during that time and to really focus on that, then you'll have a good start as an attending physician or as a higher income, higher earner moving forward. So you also asked about expense tracking and why that is important for, maybe why is that important for higher income people as well? Because I explained why it's important for when you're having a lower income. But the reason for higher income professionals is that most doctors or higher income professionals, they are either sole proprietors or business owners. They don't really get a paycheck. And as a business owner, you are now responsible for things like rent, payroll, utilities, equipment, and IT costs. And if you're a business owner and you're not keeping track of these expenses, you're not knowing where your expenses are going, then you're probably not going to be running the business very efficiently. And you might end up missing paying someone's payroll, which actually has a direct impact on that employee's livelihood. You might miss out on important tax deductions or opportunities to reduce expenses in a certain area, just because you don't know what's going on in your business. So if you're a sole proprietor or a business owner, that is why the expense tracking is important. Now, if you're not and you're just a high income salaried individual, still being able to track is important, because if you're a higher income and you're also in a higher tax bracket, there may be certain tax deductible office expenses that your company allows you to deduct that you can take advantage of, right? And so knowing how to optimize your taxes through tracking some of these tax deductible expenses is quite important as well.
For sure. And then also then using your registered accounts, for example, and If they try to lower your income, like through an RRSP, that kind of thing, FHSA, if you qualify, that kind of a thing as well.
Like spousal RRSPs too, exactly.
Yeah, there's all these kind of tools that are available to you but yeah, you need to sort of know that foundation and how they work before you can actually act on it. That makes total sense. Now, I've seen a lecture that you did on this several years ago, and clearly you've put a lot of thought into this. Can you take us through either a method or a group of methods or processes that you find tend to work best for expense tracking and budgeting? So I'm thinking more like, tactical now. Okay, we've established this is important. We established we should all do this, whether we're higher income, lower income, whether we're young or old. And as well, too, I think the sooner you start this, the better, right? Because working that muscle, developing that skill younger is a lot easier than trying to develop later, because maybe you already have those giant recurring expenses because you bought all these extra things, or you're making a lot more, so you're now spending a lot more. So I think, like, just as a parent, I'm thinking, okay, get this ingrained early on, because this is a skill they're going to be using their whole life. But moving things into kind of the tactical space, can you talk about what's worked best for you in terms of expense tracking and budgeting, or what do you recommend? What do you personally use? That kind of thing.
Yeah. So this is what I teach to my students, especially as part of developing that discipline, right? When you are still a student or early in your career, the expenses aren't going to be as high as when you are later in the career with a family, with household expenses and so on. If you're just a single individual student, for instance. And so if you do develop that expense tracking, for us, we usually recommend using a spreadsheet, just because this is what I find most accountants prefer. So when it comes to be like tax time, for instance, an accountant will want you to give them a spreadsheet, or some accountants will even provide their clients with an expense tracking spreadsheet that they want to use. And usually it's organized into those certain tax deductible items, right? But I personally use a spreadsheet. And usually what I do is, this is also part of a good monthly habit, is every month I would check my bank account, especially my credit card statements, and I would just input some of those things on the spreadsheet and organize it based on the different categories, so I can see like what I'm spending more on in certain categories, what I'm spending less on, what certain expense I need to watch for because it's really ballooning. So that's kind of how I do it as well. But I know that there are some students who might ask about, apps or things like that, or like different softwares, right? I personally don't use those, but from what I've heard from colleagues, I've heard of the one called You Need a Budget or QuickBooks. Like, those are the ones that I've seen some people will use. Maybe it's a bit more too much for a simple student, but maybe for someone who's like a sole proprietor or a business owner, they've found those to be helpful as well. The other thing that I've seen people use is some banks will have like a spending tracker. So for example, some of the ones I've heard of might be like TD My Spend or Scotia Smart Money. And it has these like graphs in it that kind of show the different insights, where people's money is going, where is the cash flow. The only issues I've noticed with some of the apps is that I don't know if they allow you to export the data to Excel. Like the ones from the banks, I don't think they allow you to export the data to Excel. And usually that's what your accountant wants to see.
So when you are doing it for your own finances, like let's say you and your husband, are you actually, like, let's say you go for a coffee or something, so something, a couple bucks, whatever it is, will you actually even manually enter smaller transactions like that just so that you have everything in there? Or how far do you take it from because I imagine in your case, like, you're a business owner too. I assume so, right? Like, you still run a corporation just due to the nature of, So, you've got so many transactions, like dozens and dozens and dozens. Do you actually enter each one manually, or do you do something different?
Yeah. So I personally do monthly. So every month when I'm paying my bills, I will enter a lot of those transactions in. And if I paid the coffee with my credit card, then yes, I'll put those in. But sometimes I might have these large expenses, like if I need to pay taxes, if I need to make payroll, if I have professional dues like memberships in the certain medical associations, rent, those are pretty large expenses that I actively log in to pay. And those I'll enter in like right after I make those large expenses. I don't usually have a lot of those large expenses or a very high frequency amount of them. And those usually just take a few seconds. But I wanted to do those because I don't want to end up forgetting about those large expenses when they come.
Gotcha. That makes sense. Yeah, I always like asking this question because different people do it different ways, and technology has advanced quite a bit, but I find it's still not perfect. I haven't found sort of this one perfect solution where it's super automated, takes very little time, and is still accurate and still includes all the transactions and has no bugs. And now a quick message from one of our sponsors. We spent years and eventually decades optimizing our portfolios, maximizing our RRSPs and TFSAs, and fighting for every fee and tax deduction that we can find to help us reach financial independence faster. But we often overlook the one vulnerability that can jeopardize all that hard work in an instant: online security. I have been using Talos Online Security to keep my and my family's data and devices safe at home and on the go, and now I can stress less about sketchy links, phishing emails, and hidden data breaches. My favorite part is that it is a comprehensive, all-in-one suite of tools. I used to juggle multiple companies for my online protection, whether it was antivirus, VPN, dark web, and credit monitoring, just to name a few, but I still wasn't sure if I actually had all my bases covered. These days, I just use Talos Online Security. It covers all my bases in a single intuitive product, and it makes managing our online security so much easier. It's also much more cost-effective than dealing with multiple different companies that each tackle only a small portion of your online security. The plans start at just $12 per month, and you can see the plan that I use over at buildwealthcanada.ca/Talos. That's buildwealthcanada.ca/Talos. Yeah, for myself, I've used YNAB for quite a bit. I don't use it anymore, actually, but you mentioned You Need a Budget, which is YNAB for those not familiar. And then I've used QuickBooks as well back in the day when I used to be part of another business. So I found out with QuickBooks, I think it's still pretty much intended for businesses. So if you're running one, then I've spoken to other people who they have a business, so they use QuickBooks for that. But then they also, because they already taught themselves how to use QuickBooks for their business, they use it for kind of their personal stuff as well. So I've heard that's one approach. I know quite a few people that use YNAB, that You Need a Budget as well, and that are very happy with it. For me, I used to use it. I used it for several years, but what the issue I found with it was, for me, the big thing was for it to sync with my different institutions so that it can download the transactions and automatically categorize them. And sometimes it would work great, but sometimes it wouldn't. And so I would have to re-authenticate all the time. And then sometimes like the service is down. And then once for some reason didn't import like half a month of transactions, right? And so because of those issues, basically, it's a great software, don't get me wrong, but that particular functionality, especially for Canadians, I kind of reached a breaking point where I'm like, okay, I'm trying to synchronize. I'm running into this issue where it's not doing it correctly for the 13th or 15th or 20th time. I'm frustrated now. I'm going to try a different approach because I'm like, is it actually saving me time when I have to keep troubleshooting and reconnecting and waiting for the service to be up and that kind of thing? So now I'm experimenting right now with just doing an export, like a CSV file, and then importing that into my spreadsheet. And then you can actually do formulas using AI or just with an Excel or Google Sheets to automatically categorize them for you based on your criteria. So that's kind of what I'm experimenting with now. I've been doing it for a few months and so far it's working well. So I guess stay tuned. But I do like it because it's also like I don't have to worry about, did it forget to import a transaction? It's like, no, it didn't. I'm pulling it right from the credit card provider. And yeah, there is that manual process of downloading the CSV file. But like I said, when I tried the automatic thing, the issues would happen so often that it actually would have been quicker just to get CSV file, copy, paste, you're done. And then it auto-categorizes like 90-something% of them. So anyways, that's how I do it. I thought that might be interesting to the listeners because long-term listeners of the show know I've been kind of playing around with this for a while, trying to find the ultimate sweet spot. But it's hard. It's hard. We're not in a stage yet, unfortunately, where there's this open banking thing that's working perfectly and we can download everything from multiple institutions and everything's there just because of all the security and stuff like that, right? So it's really, kudos to you for being diligent like this and actually entering it yourself manually. Because obviously you're really busy, but I think that too kind of really speaks to how important this thing is, right? Because you could be doing so many other things and yet you believe this is important enough to actually do. And especially as a business owner, it's like you don't even really have a choice because you don't want the government coming after you because you haven't been tracking correctly. So thank you so much for that. I just thought I'd share my own thing too, like what works, what's worked and what hasn't for me, because I know lots of listeners struggle with this as well. Okay, that's wonderful. So doing this myself, I've noticed that there is a direct sort of trade-off where the more detailed of a breakdown you want of your expenses, the more time it takes to track everything on an ongoing basis. So for example, a person could track on just a broad level where they're just breaking down expenses into, okay, here's my discretionary versus non-discretionary expenses, just two categories, very straightforward. I've tried that approach, while others go to kind of a much greater detail, breaking down items into much smaller categories. So like, okay, this was groceries, this was for hydro, this was for restaurants, etc. What level of detail do you suggest and why? I think you've already answered this. Like you actually do categorize it at a pretty detailed level, right? Even for your own personal expenses, it sounds like.
Yeah, so I'll kind of give you like a different answer for someone in your audience who was salaried, because I used to be salaried when I was still a resident physician. And then I'll also give a different response for someone who's a business owner. So the whole point of tracking any of the data is it all depends on your end goal. Like, why are you using that data? What are you going to use it for? What kind of behavior change you might want to promote more of? So for someone who's salaried, where maybe there might be fewer tax deductible expenses compared to a business owner, a simple like needs, wants, savings category could just be a general guideline to start. So there is this rule called the 50-30-20 rule, which says generally, 50% of your paycheck can be allocated to needs, 30% can be categorized as wants, and 20% to savings and debt. And so how can you use this type of guideline to manage your behavior is, let's say you're tracking and you see that your wants category for this month has really gotten bigger because you had bought FIFA tickets or something like that, right? So then next month, you can think about your behavior and how can you change the behavior to spend less in this category to make up for it. If you're saving up for a new home, then, maybe seeing that you're not meeting the benchmark for this in the savings category, well, this is more data for you to inform your behavior change. So you can try and increase the savings next month or take it from another category that you would have otherwise spent it on, right? So just like how I said earlier, if someone's blood sugar levels are up and I told them, we're going to go check your blood sugar levels in the next 3 months. Well, it's during those 3 months. That's when you really want to bring it down. You don't want it to consistently be high. So you might do things like change your behavior, put less sugar in your coffee, or maybe eat more consistent meals, for example. So when you're a business owner or a sole proprietor, there is a form called the T1215, and there's a section on the form, part 4, and it actually shows a list of expense categories. Some of these might include utilities, office expenses and supplies, repairs and maintenance, etc. And that's the categories that I use on my own expense sheet as things that could be business deductions. Now, this involves a bit more detailed tracking because your accountant actually needs all these detailed categories to fill out this particular form for your taxes. So that's why I say for a business owner, maybe it's a bit more detail. And as a business owner currently, that's why you're probably seeing that my tracking is in a bit more detailed manner. And then the point that you made about the downloading the CSV, yes, so I do that as well. You can just download the .csv. It comes in like an Excel sheet format directly from your credit card statement or from your bank account. And I think you said you were using AI to categorize them. I just copy and paste it into each of these categories on my own sheet. So yes, until that is actually getting automated by AI, it'll definitely save me a lot more time. But I find the time spent just copy and pasting things and into different categories is also really important, because I forgot to mention about fraud and how there's a lot more fraud happening these days with, expenses coming on your credit card statements or on your bank account that you've not seen before. That has happened to me where I've seen certain bills coming from my credit card and I was like, hey, I never actually paid for this kind of stuff. So the fact that I close watch over some of these expenses and categorize them myself helps me pick up on, unwarranted expenses that I did not pay for myself. And I was able to address those fairly early on so that I didn't end up having to be financially responsible for some of those expenses that I didn't make myself.
Awesome. Thank you. I noticed that you also talk about debt a fair bit in your lectures. And I suspect that's because, like you mentioned before, doctors are in debt initially for the most I imagine are, considering how expensive medical school is. However, many non-doctors finish with school-related debt as well. And even for those that don't, a common dilemma that many Canadians are faced with is where to allocate their cash surplus after essential expenses are paid. For example, do we pay off school debt first or our mortgage, or do we allocate that money for retirement or recreation or some other category? Do you have any frameworks or rules or processes that can help listeners decide on either what to focus on first or how to split the pool of money amongst these different categories?
Yeah, so generally, when it comes to frameworks, there are two that I could think of. One is called debt snowball and one is called debt avalanche method. So the debt snowball method is basically you pay the smallest balance of debt. So when you have multiple different types of debts like mortgages or student loans or car loans or things like that, looking at what is the smallest balance, which one has the smallest balance, and pay that off first. And then that will motivate you to keep going because of the quick wins as you tackle larger debts. Then the second strategy is like debt avalanche, which is when you're tackling debts with the highest interest first. So out of the two options, from a behavior perspective, debt snowball might be best if you're behaviorally driven. So you're motivated based on these small wins, and this motivation will drive you as you tackle some of those bigger debts. But from a financial perspective, the debt avalanche method actually makes the most sense because usually the highest interest debt also tends to have a large balance as well. And so, let's give an example. So like provincial loans, a lot of students will have provincial loans, and these are usually prime plus 1%, at least in Ontario. And a lot of students will also have a line of credit for professional students, which are prime minus 0.25%. Mortgage loan interest rates also tend to be lower than the line of credit. And then federal loans are 0% at the moment. So maybe you can tackle those less at the last. And so the good thing about paying loans is that it's actually pretty easy to pay. It's pretty tax free. Like you don't have to pay tax because you paid a loan. And this also helps a lot with your credit score. So if you get a good credit score from being reliable in paying down your loans, this can help you get better rates on other loans you may make in the future. And so when you're thinking about, okay, so like I have all these different debts, but I also want to be on the right step to investing. Like I have so many of these different financial priorities. How should I decide? Like, should I invest or should I pay debt? The one thing to think about is when people ask me like, oh, like I want to invest first, even though I have a lot of debt, but I want to invest. I just don't know what to invest in. And sometimes people will have analysis paralysis because there's so many different investment options that they just don't end up investing at all. So the money just ends up sitting there, not going to that, not going to the investments. So if you do happen to know what you invest in, you can always do half, right? Put one half towards the investment you want to make, whether it might be for your saving for your first home or saving for retirement, whatever that might be. And then you could put the other half of whatever is coming in to paying debt. If your debt is just very high and the interest and the principal payments are very cash flow heavy, so because the number of your debt is so high, even if the interest rate is a small percentage, the overall that small percentage of a large number is quite significant on your cash flow, then I would prioritize paying down the debt because then it'll free up that cash flow some more for investing in the futures. And so these decisions are often psychological because some people just feel very uncomfortable carrying a very high debt. Like they might not be able to sleep at night because they're worried about the high debt. And especially if you are someone who's in that category, it can be quite freeing to be debt free. And that is also, a step to becoming financially independent, not having to worry or have the pressure of having to work a job just that you don't necessarily enjoy just to service that debt because you're tied to that debt, right? So hopefully that's kind of like a bit of a decision-making process onto, what you should allocate your money towards. Should it be towards investing? Should it be towards paying debt? It's very much of a psychological, behavioral reason, but also if you're going to be thinking too much analysis paralysis and end up not doing anything with the money, sometimes it just could be mentally easier to just put it towards debt every month if you can't think of what you're going to put in terms of investments. So hopefully I answered your question there.
You did, and I really liked how you mentioned the cash flow impact piece. I hear that component mentioned less often, but I could see that making a lot of sense, especially I'm thinking what came to my mind when you mentioned that was something where somebody purchased a large house or expensive house. So, and they took on a really big mortgage for it. And maybe they got a really good interest rate, relatively speaking, on that mortgage. But because of the amount of the loan, the cash flow hit every month is really massive. And so now they're kind of in the situation where, okay, if one of us lost our jobs, we would be in huge trouble just because, and maybe can't even go on vacation anymore and that kind of thing because the cash flow drain is so significant. But look, we got a great rate. Okay, wonderful. But that cash flow hit is still so massive just because of just by the sheer quantity of money you took out. So I really like how you mentioned that element because I think that's often not looked on, but that can create a lot of stress and anxiety as well, right? Like interest, like imagine that mortgage is a variable rate mortgage and yeah, you got a great deal on it, but now the rates, let's say they went up and now you're even more stressed, right? So yeah, that's a very, very interesting consideration. I noticed in your curriculum, one of the topics covered is the emergency fund. And this is something that I personally wrestle with, even to this day, just because while it is an excellent anxiety reducer, I find it can be, and of course, it can be very helpful in weathering the financial storms in our lives. I still always in the back of my head, I'm like, well, every dollar that is sitting in a safe investment is not generating that much higher expected return that it could earn if we instead, let's say, took that dollar and just invested it in a broad stock market index fund, for example. Is this something that you find to be challenging as well? Or have you found some sort of framework or way of thinking about it or rule that has helped you kind of lay this dilemma to rest? Because for me, I went to business school and we have the opportunity cost thing drilled in our brains from year one. And so everything is always opportunity cost. And so that, like to this day, it's still in my brain. So yeah, what's your take on that?
Yeah. So I kind of categorize, holding emergency fund the same as like paying for any type of insurance, like auto insurance, health insurance. Sure, like you could not have health insurance, but you never know, right? So you never know what will happen. And sure, I could not pay the thousands of whatever I pay for health insurance and use that to invest instead, right? But it's similarly, like holding an emergency fund is pretty important because, you never know when you're going to actually experience either a medical emergency or a work-related emergency layoff that suddenly takes away your ability to generate income. And for me, like I can give you a very direct example, which is like I had a high-risk pregnancy, which means suddenly I had to drop my job on short notice to have a C-section. And I know colleagues who have had acute issues like car accidents or cancer diagnoses or heart attacks. And that is sudden and it impacted their ability to work. And so, that's why I said I think about emergency fund like an insurance, right? You could not pay for an emergency fund. You could not pay for insurance and use that money to make a higher return in the stock market instead. But when it really matters most, like when you're suddenly out of work or you suddenly need to pay for an expensive treatment, it would have actually cost you more than if you had just not gotten that insurance in the first place. So for a lot of doctors, for example, I will super recommend getting disability insurance because your ability to work is your biggest source of income. And, usually for a lot of physicians, there's an elimination period for disability insurance, and that's usually 3 months before the disability insurance kick in. And so either having your line of credit open or just having an emergency fund to cover those 3 months until the disability insurance payouts come, like that could be, really helpful. And so that's why some people will say, you'll see in these like personal finance books, like how big should your emergency fund be? It's generally about 3 months of your lifestyle expenses, or some people will say 3 months of your salary would be the emergency fund amount. And that's meant to, cover those household expenses should you no longer be able to make anything during that time. On the insurance piece, there is also something called critical illness insurance, but note that it only usually covers certain critical illnesses. So usually there's around 25 or 26 of them, such as like stroke, cancer, heart attack. But there are also a lot of situations that are not covered by that list. So in my case, it's preterm birth, early pregnancy, or early delivery of a pregnancy. And so that is like an example that I talked about where, you suddenly have to drop all of your work and not make income, but that's not considered a critical illness, for example. But it happens to a lot of women in the workplace who have high risk pregnancies, for instance.
And now a quick message from one of our sponsors.
It's the small things that make us Canadian. At BMO ETFs, all of our tickers start with Z. That's right, Z, not Z. From ZSP to ZEB, we know how to build solutions for the Canadian investor. So the next time you invest in ETFs, consider a Z instead. Visit BMOETFs.com for more.
There are so many opinions on how to invest your money today, but it can be hard to find credible voices to rely on in the world of finance and investing. One resource I turn to every week is the ETF Market Insights YouTube channel, led by today's episode sponsor, BMO ETFs. Market Insights brings in industry experts, and their weekly episodes cover the hottest themes like inflation, infrastructure, healthcare, and more. Tuning in helps me stay up to date on what's happening so I can be a smarter investor, and you can also submit your own ETF questions to be answered on the show. So do yourself a favor and subscribe on YouTube to ETF Market Insights or visit etfmarketinsights.com so you can be notified when future episodes go live. And now back to the show. Yes, there's the critical illness and then the disability, the two separate insurance pieces, right? And so I think that's something that it would be worthwhile for individuals to look into as well, because sometimes too, I know a lot of people will have one, the other, or both through their work. But then one common thing I've found too is that sometimes the coverage isn't as good as you think it would be. And so it's very easy to sort of take the shortcut and say, oh yeah, the HR department at work told me we have it. And then, okay, now I don't have to think about it again. Okay, well, but how big is the amount? What's included? Are there exemptions? Because you may want to have a supplemental one as well, because maybe the coverage isn't that good. Like, especially if you're a doctor, right? And let's say you've got that $150,000 in debt, for example, for medical school. Okay, and then also all this earning potential, right, over the years, is what you're kind of getting from some organization really sufficient? I think that requires some analysis. It's more work, but I mean, yeah, you're investing so much in yourself as a doctor. I can see why you would want that coverage, even though it is pretty expensive, I think, generally, right?
It is. Yeah, it is pretty expensive that you have to pay either a lump sum in the beginning of the year or monthly. But this is something I would suggest for anybody who's listening, who's a sole proprietor, entrepreneur or business owner, right? A lot of times, since you don't have an employer, you are the employer, and your ability to generate income through your business or through yourself as a person, that's something that needs to be protected, right? So yes, I could invest that amount that I'm paying to disability insurance every month, but it is also a small amount to pay for, if a sudden work emergency happens and I lose out on all those years of future income.
A question for you just kind of came to me here. We were talking earlier about the budgeting piece and the transactions and all that piece. And you mentioned fraud being something that is of concern and that you're able to catch things by managing it at a detailed level. When it comes to your investments, do you do the same kind of thing? This is one of the things I've been kind of curious about lately, because I was rebalancing my portfolio and I'm thinking, okay, there's all these transactions, like the dividend payouts and contributions and all that. And I always look at our detailed credit card statement to make sure there's no fraud there. But what about on the investment side, right? In terms of like withdrawals and things like that. Do you do anything on that side yourself?
So for the investments, generally not every month, but for every quarter, I kind of just look at, how my investments are doing in general, like how much dividends I'm getting or how well my certain investments have performed. I find that it tends to be harder for people, like for fraudulent parties, to address investments, because there's usually like a certain period of time in order for investments to be sold, and then for the money to be taken out, and usually it gets deposited into your bank account first, and then it might get taken away, right? So because there's more steps, it's a bit harder, I find, for fraudulent activities to appear in your investment accounts versus like in your bank account or on your credit card statements, for example, right?
Yeah.
So that's just something that I usually just check, but I don't make frequent trades or anything like that, right? I usually am more of like put a lump sum in and more passive sort of strategy. But I would think if you are making more frequent trades, it might be important to just check on those and make sure those are all correct. This might be more of an advanced thing, but for tax purposes, sometimes I will track adjusted cost base as well. And those are, those that I track, it's for my accountant, right? For tax time. And that means that I just have to track some of my trades a bit more often. But yeah, I do agree that I think, as long as you are kind of getting a good handle on your overall portfolio, what's going on with your portfolio, that's quite important as well. But in terms of whether the question is, do you notice more fraudulent activities happening in investment portfolios in general? I would say from what I've heard in terms of the people I teach, that happens less commonly compared to credit cards and bank accounts when it comes to investment portfolios. But, I don't have the exact data on this, so I can't provide you with a data-based answer, but this is just what I've noticed amongst the people that I teach.
That makes sense, yeah, because with a credit card, a lot of people are putting that information in to buy something online. So you're literally entering it in there, or all it takes is a tap with a credit card or with your phone.
Exactly. It's more easy to access that information than trying to log into someone's brokerage account.
For sure. And it's like, then you got the dual authentication and all the different things there, and authenticator apps, which I recommend, by the way, using for your brokerage. So yeah, that's true. So yeah, there's a lot more hoops to jump through. And then like you said, then you've got they actually would have to move the money out. So wait, now you're moving it out to an account we've never seen before. That's going to get flagged most likely by the brokerage as well. That looks suspicious, right? So there's quite a bit.
Yeah, I would say maybe in cryptocurrency, maybe I've heard more cases of fraud there. But if you have a very traditional investments and things like that, it's less likely to see that. Or even if you let's say you're not a passive investor, you're more of you have an actively managed mutual fund, or you have a fund manager. Yeah, there's another person you have to get through, right? So because brokerage accounts and investment accounts tend to have more steps in the process to access the account and also to take stuff out of the account, maybe that's why I haven't heard as much from the people that I've taught around fraudulent activities there. Crypto might be a different picture altogether. Yeah.
Sounds good. Yeah, I was just curious, to see if you have a certain process for that. I think, you bring up a good point. I think especially if you're in the contribution mode where you are working physician, working professor, you're contributing, right? You're not really taking money out of retirement because you're still in your active working years. So I think it's different, right? Because you should be seeing just a lot of contributions, not really many withdrawals, unless you're moving money from your non-registered account to your TFSA when you get more contribution room in the year. But usually you're not seeing things moved in that kind of way on a kind of day-to-day basis. But I'm thinking, I guess more so in our case, we do withdraw from our portfolio, kind of being basically being semi-retired now. So there are a lot more transactions where okay, money coming in, money coming out. And so it started, so I was just kind of thinking hey, I should actually have a good process to audit this periodically just in case. So this is sort of a new thing that I've been looking into. So no, that's great. Thank you. You mentioned the adjusted cost base as well. For anybody new to this, that's more on the non-registered accounts or your corporate account as well, right? Not your RSP, not your TFSA. In those ones, so it sounds like you actually track it yourself in a spreadsheet manually, and then do you verify it with what the brokerage has?
No, so actually there's a good website. Maybe your listeners can access it, or you could put it in the show notes. I think it's just called adjustedcostbase.ca. If you just Google adjustedcostbase.ca, it'll probably be the first thing that pops up.
Okay. I think I'd have to Google it later, but I remember there is one for Canadians specifically where they actually track it correctly and such. Yeah. Okay, so you put in your transactions there, and then they're able to do it for you.
Yeah, and you can. Okay. I think you can download it as a spreadsheet after as well.
Okay, that's great. I know as a best practice, you're supposed to compare it to the brokerage and make sure everything matches up correctly, that kind of a thing. So yeah, I'm always curious to see how others do it, because it is a pain and it's so easy to make a mistake as well, right? You forget to add one thing or whatever, or make a typo or something. There's just so much potential for human error. It's pretty wild. Less so, I think, on the brokerage side.
Some accountants might do it for you. So it depends whoever your accountant is, who you end up working with. You can ask them if they will track it for you as well.
Oh, okay. Gotcha. Yeah. So far, I've had a good experience with the brokerages doing it, I guess, because they have to, and it's kind of automated. But I've also heard, sometimes you hear stories about them making a mistake, and then maybe you're getting taxed a bit more than you should, that kind of a thing. So But yeah, that's kind of more of a, I guess, just for people that are investing in non-registered accounts because they've maxed out their TFSAs and RSPs and all that, and corporation owners as well. But okay, sounds good. So let's finish things off here. You're very involved in philanthropy and really trying to maximize financial literacy here in Canada. Are there any specific programs or initiatives that you'd like to talk about in case any of the listeners are interested in helping out or contributing or just learning more? And can you tell us more as well about where we can learn more from you?
Yeah, so I run a national philanthropic conference, and it's for physicians, dentists, or other professionals. And even though it's called the Canadian Physicians Financial Wellness Conference. So we donate the ticket sale proceeds to various causes related to financial literacy or healthcare. So for example, we funded like financial literacy and home ownership classes with Habitat for Humanity. We've created an endowment fund for a needs-based scholarship at the University of Toronto Medical School called the Equity Award. And we also funded a training fellowship at Sunnybrook Hospital to train more physicians who are specialized in mature women's health. And so to kind of learn more about the causes we support and to, if you want to support those yourself, we actually have a page for that where we directly have a little picture of the cause. And if you click donate, then you'll be taken to that particular charity's donation page. And to find out more about that, you would just visit physiciansficonference.com/philanthropy. And yeah, so basically as a conference, we teach professionals and also students not only about paying down debt, but also investing, optimizing investing if you're incorporated. And we try to talk about estate planning and retirement planning. And then as a conference ourselves, our values is to set an example of paying it forward. So, even though we teach people to have a good foundation with their finances, the end goal is when you are financially stable and you're financially independent, you would know you have a bit left over and you can use that to pay it forward to a charity or to someone else. So we try to set an example of that ourselves. For me personally, if you want to learn more about some of the lectures that I teach, you can find me on Instagram or YouTube as Breaking Bad Debt. Breaking Bad because I like the show Breaking Bad, and I also do addiction medicine as part of my practice, and debt because I'm combining my two interests together.
Wonderful. Thank you so much. I'll be sure to link that out in the show notes as well. And then, if you want to Google Dr. Steph on YouTube, she's done some excellent talks and other interviews as well. I've really, really enjoyed them. I remember first time I saw Dr. Steph was with Mark Soth. I think you guys, I think you were interviewing him or vice versa. Yeah. So it was really the loony doctor, as he's known to many Canadians. So it was really nice, very high quality education, very beneficial to Canadians. So so Dr. Steph, thanks so much for all your contribution. I mean, both on the philanthropy side, but also on the financial literacy side and just trying to help so many people. It's just very thoughtful of you. And I can see you put so much effort into it. And so it's nice to be among fellow Canadians like yourself to help people just make better financial decisions and help people out. And it's just, it's really, really nice to see. So thanks for all your contributions in all those areas.
Great. Thanks for having me, Cornell.
Okay, wonderful. Thank you. Bye. All right, I hope you enjoyed the episode. Please share it with someone that you think may find it useful. And of course, leaving a review on Apple Podcasts or Spotify is always super appreciated as well.
Thanks for listening to the Build Wealth Canada podcast at www.buildwealthcanada.ca.